John So isn't your typical hedge fund manager. While others buy and sell stocks, bonds, or currencies, John invests in natural disasters. In fact, he's one of the biggest players in the market for so-called catastrophe bonds. And with hurricane season upon us, John is busy watching out for the next Katrina. John So is co-founder and managing principal at Fermat Capital Management. He's here with me this morning. John, thank you for coming. And let's just make it clear for everybody what cat bonds are. They are effectively insurance against natural disasters. So if you invest in cat bonds, you're effectively providing insurance to insurance companies who have insured the likes of folks in whether it be Miami or New Orleans or something like that, correct?
That's right. If the disaster happens, we lose money.
Okay. Let's talk, though, about the recent hurricane predictions. The NOAA predicting that we may see as many as 25 named storms this year. As an investor, right, everybody gets all excited about headlines like that, but as an investor, somebody who has money on the line, do you put any stock in predictions like that?
No, not really, and not this early in the season. I mean, the NOAA has the best science on the subject. We monitor it very closely, but we don't really pay attention to that this early in the season.
Now, how come? Why does the earliness factor make the difference?
Well, it's just that there are other factors. The science is progressing on the subject, so they monitor certain basic factors like sea surface temperature. But there are other things that investors care about, in particular landfall. So right now they're just predicting how many hurricanes potentially will be out in the open ocean, not how many are going to hit Miami or Manhattan. So
let's talk about this exciting market for catastrophe bonds. I mean, the name alone just makes the mind boggle. What does it tell us about hurricane risk? Is the market or cat bond prices a better predictor of where hurricanes might make landfall or perhaps the kind of damage they may cause than an outfit like the NOAA?
Right. I think that they're as good a predictor as you're going to get. We take the science from the NOAA, but then we further apply it to what it can actually do to human property. And those expectations are fully reflected in the prices of cat bonds.
We all remember disasters like Hurricane Andrew, obviously Hurricane Katrina. How has this market evolved in the wake of 1992, 2005? Is it a better place to invest, an easier place to invest? Should people look to cat bonds as an alternative to, say, stocks, bonds, or currencies?
Yeah, absolutely. Post-Katrina, the market's over tripled. It's increased in breadth, sophistication, and the rate of growth is definitely accelerated. It's probably a better time than ever to be considering this market.
People talk about cat bonds being an uncorrelated asset. However, so many assets that were referred to as uncorrelated, meaning that they don't follow stock prices or bond prices, proved in fact to be correlated. Is this still uncorrelated in the sense that the stock market could go to hell and cat bonds will still perform according to what's happening in the natural disaster world?
Right. It's fundamentally uncorrelated, and so that investment thesis is still intact. I think that what you see in the catastrophe market is perhaps the opposite of what you see in other alternative classes. You might have some correlation on a daily basis, but when it really comes to the big one, it doesn't move with the rest of the market.
John, it's been wonderful to have you here. Please come back once we actually see some hurricanes making landfall. God forbid they cause terrible damage, but we need to get your perspective. John So of Fermat Capital Management, everybody.